Hey everyone, hello again. Welcome back. One of the coaches at Unger Academy here. And today we're going to be doing an overview of the markets. However, unlike what we do every week, because it'll be a little bit more long term, just to see the interesting things that have happened in the last 6 months. Before we begin, however, I invite you to subscribe to our channel, leave us a like, and click on the bell to stay updated on the release of all our new content. Hi, we are the Unger Academy, and we teach traders how to make money in the markets. Our founder, Andrea Unger, had been struggling with trading for years until he developed his automated trading method, which he used to become the only 4-time world trading champion. Subscribe to our channel for free tips and tricks. All right, so let's start as usual with the stock indexes. Now, in this chart, we can see the Nasdaq and how it has performed last year. Now, it's quite easy to see that it was a good year end, and in the last 5 months, the trend has reversed, despite a notable rebound in the last few days. We're talking about a plus 7% in the last 5 days. So a market that has had 2 fairly major leg downs for an overall decline of more than 30% from high to low. Now the situation was very different on the other indexes. We can see in this chart the mini SP 500 also with the 2 down legs and a fairly strong rebound in the last 5 days. The decline of the mini SP 500 was more moderate. It's a little more than 20%. So it's already of a certain magnitude. If we go take a look at the 1-year return, we can see that it is negative for all equity indexes. So at the moment, we see a pretty large bearish trend with corrections above 20 to 30% that are not, that frequent in these markets. So let's hope that we've come close to the end of these trends. Now, as you all know, there are fundamental reasons that are undermining the resilience of the markets. The tension related to interest rates resulting from the US central bank policies, namely the rate hike that is weighing as a regressive measure for the economy. And these rising rates also result from tensions in commodity markets, which means that inflation is very high. And so the US central bank is trying to put a brake on that by raising the rates. So let's see how far it can go because obviously, as mentioned before, raising rates will definitely weigh on the economy. In parallel with the decline in equities, we've also seen a decline in bonds, which is also a natural consequence of rising rates. So bonds prices have also gone down, and we've seen a strong bear market on all bonds. In this case, we're seeing the UST bond, the US 10-year bond, and the European 10-year bond, namely the Bund. We can see that all of them are down between 8 to 9%. There is a downtrend in bonds as well as in equities. This is quite a difficult situation, especially for the investing world, because, it's mainly composed of these 2 asset classes, the bonds and equities. And if they both go down, it's surely difficult to build efficient portfolios. On the other hand, the energy sector has undoubtedly performed very well. Take a look at the crude oil. We can see it in this chart from about a year ago. We see a very strong bullish trend. And let's not forget that it had even touched negative prices during the COVID period. So this was certainly a remarkable run-up. Of all the energy markets, however, crude oil is one of the worst performers. Because if we look at the 1-year performance of other markets, we see much higher returns. Positive 358% for heating oil, plus 156% for natural gas and 123% for gasoline. Of course, the macroeconomic tensions arising from the war between Russia and Ukraine are weighing in on this sector. As we all know, this is reverberating in a sharp rise in commodity prices, particularly energetics and grains. Turning to the metals market, we've been saying this for a long time. They haven't had a trend or even a directional movement. You can see that at 1 year they have had mainly negative returns. The worst performer is certainly silver. Here's platinum, while gold is pretty much unchanged. Negative returns also on the meat sector. Here again, not much to report, while instead we can see a remarkable price growth in soft commodities and grains. Among the soft commodities, those that grew the most were undoubtedly orange juice, up by 55%, cotton up by 77%. Let's just turn on the standard deviation. Here we can see the volatility in the chart below. And for all the underlying assets, it's clearly high. And we'll have a closer look at that in a bit. Now, turning instead to the grains sector, we have noteworthy returns, especially on wheat. We know that it is one of the commodities produced in Ukraine, and so the tension of the war has spilled over into this agricultural commodity. Not only that, we can generally see positive one-year returns on the whole sector. If we turn to take a look at the currencies, we'll see the strength of the dollar is quite evident. The euro dollar has lost about 12% in a year. Let's also take a look at the trend. Decidedly bearish. It's clear that 12% on a currency is a fairly large movement because usually the volatility of these instruments isn't comparable to those of other commodities. And we're finding this trend in all the currencies. So the dollar is strong against all other currencies. Well, the cryptocurrency sector, that's also weak. I mean, Bitcoin lost about 21%, almost 22% from a year ago. It's on significant lows now. It had broken through the threshold of 30,000, but recently recovered it. The whole cryptocurrency sector is suffering right now, and all in all, Bitcoin is one of the markets that is holding up the most. Let's take a look at volatility, measured as standard deviation, so as historical volatility. And we can see that over the long run, so I'm referring to the one-year time frame, we have percentile values that are still very high. 95th percentile on both the Nasdaq and the mini SP 500. We certainly have high volatility on bonds as well. On energetics, a little bit less. So there's high volatility in soft commodities. Look, 98% on currencies. So in general, it is a situation that reflects the instability of markets in the current period. Finally, let's take a look at the term structure of implied volatility. In this chart, we can see the VIX, which is at quite high levels, among the highest levels of the last year. It touched a high of 39. So we're approaching the psychological threshold of $40. All in all, when comparing these spikes to the magnitude of the downturn, it occurs to me that, yes, volatility went up, but there was never any real panic. Because by looking at the term structure of the volatility indexes on the SPX, there were brief moments of backwardation. At the moment, we're back in contango. However, we haven't seen anything particularly extreme, especially compared to the downtrend in the indexes, which certainly is of a considerable magnitude. With that, guys, our markets overview is over. I'd just like to remind you, though, that if there is someone among you who is interested in systematic trading, we're going to leave you a link in the description of this video. Through this link, you'll be able to participate in a free presentation by Andrea Unger, who will introduce you to his trading method, which enabled him to win the World Cup Trading Championships 4 times. Not only that, but you'll also be able to book a free strategy consultation with one of our tutors, or get a copy of the best-selling book, The Unger Method, by paying only the shipping costs. With that, guys, that's all for today. I'd like you to please, just to remind you to subscribe to our channel, click on the bell to stay updated on the release of all our new videos, of course, if you haven't already done so. And if you enjoyed this video, please leave us a like. And with that, have a fantastic weekend, and we'll see you soon in our next video. Bye-bye.